Ever found yourself excited by the allure of dividend investing, only to wonder why the promised returns aren't piling up as you expected? Dividend investing seems straightforward. Pick some solid stocks with nice yields, sit back, and watch the cash flow in. Yet many investors, perhaps even you, stumble into pitfalls that can drastically affect the outcomes. So, why do some seemingly attractive dividend options turn into financial sinkholes, while others flourish and bolster your portfolio? And more intriguingly, could there be hidden gems in your strategy that you're yet to leverage fully? Stick around as we explore not just the common blunders, but also the lesser-known strategies that can transform your dividend investing journey. 1. Not considering the payout ratio. Let's dive into a concept that's like the unsung hero of dividend investing, the payout ratio. Think of it as the financial compass that shows how generously a company is sharing its earnings with shareholders through dividends. Here's the deal. It's not just any number. It's the slice of the profit pie that companies hand out to their investors. And here's how they figure it out. They take the total dividends they've doled out and divide it by their net income. Simple, right? Now, you should, as an investor, keep an eye on this because it's your sneak peek into the company's future. It's like having a crystal ball that gives you a hint whether those dividend checks will keep coming or start shrinking. A sky-high payout ratio is a red flag. It could mean a company is stretching itself too thin, risking dividend cuts if their earnings take a hit. But here's where it gets spicy. There's no one-size-fits-all number. What's considered a healthy payout ratio can vary depending on the industry and the company's growth stage. For the young guns focusing on growth, a lower ratio is totally fine. It means they're plowing profits back into the business, which could mean even bigger dividends down the road. On the flip side, a ratio that's more middle of the road, think 30 to 50%, is often just right for established companies, balancing dividend payouts with reinvesting in their future. Then we have the high rollers, with payout ratios over 50%. Here, investors should tread carefully, scrutinizing if each generosity is sustainable. And if we hit the 100% mark or above, we're in the danger zone. It's like the company is emptying its pockets, paying out more than it earns. That's a recipe for trouble, and you need to be careful. 2. Not considering the yield traps. Now, let's tackle a sneaky pitfall in the dividend investing world: yield traps, or simply a dividend trap. You know, those alluring high-yield stocks that whisper sweet nothings about massive returns? Tempting, right? But beware, not all that glitters is gold in dividends. So what's this yield trap thing? Imagine a stock waving at you with a juicy, sky-high dividend yield. It looks irresistible, but hold up. Sometimes it's a facade hiding some not-so-rosy realities. These are the too-good-to-be-true yields that can ensnare investors into a risky situation. How do you dodge this trap? Unfortunately, there's no magic formula. But keeping an eye out for red flags is your best bet. Think unusually high yields that don't fit the norm, a mountain of debt, dividends chomping away more than the company earns, or a cash flow chart that looks like a scary roller coaster. Let's pull up a real-life example. Picture BlackRock's Core Bond Trust, or BHK, which sports an 8.2% yield. With a name like BlackRock behind it, you'd expect this fund to be a safe bet, right? But the past 5 years tell a different story. It's been trailing behind the high-yield benchmark, which is not really what you'd hope for from a fund that should have an insider's advantage in the bond market. And here's the kicker. BHK is priced at par with its NAV. That's financial speak for you're not getting a bargain here. Essentially, you're facing a double whammy: lackluster performance and a price tag that offers no extra value. So, while jumping at the high yield might be tempting, taking a closer look reveals why it's a prime example of a yield trap. 3. Not considering tax. Next up on our investment journey is a topic that might make you groan a bit. Taxes. Yeah, I know, it's not the most thrilling subject, but stick with me. When diving into the world of dividends, it's not just about the cash flowing into your account, it's also about how much of that cash you get to keep after taxes. So here's the lowdown. Dividends don't all get treated the same way by the taxman. They're split into two groups, qualified and non-qualified. And yes, this distinction greatly affects how much you owe Uncle Sam. Let's say you're eyeing a dividend that's supposed to beef up your wallet. But hold on, have you considered how much of that is yours to keep? Depending on your income, you could be paying anywhere from 0% to 20% tax on those dividends. For instance, if you're in the 24% tax bracket, you'll shell out 15% on qualified dividends and the full 24% on the non-qualified ones. Now, it might seem like a bummer, but there's a silver lining. Qualified dividends get a tax break, meaning they're taxed less than your regular income. This is a sweet deal, especially if you're in a higher tax bracket. But wait, there's more. You can actually strategize to keep more of your dividend earnings away from tax bites. How? Well, one savvy move is to park your dividend-paying stocks in a tax-advantaged account like a 401k or IRA. Dividends in these accounts grow tax-free until you decide to take the money out. And if you're all about efficiency, look for stocks that pay those favorable qualified dividends and don't trade too often. It keeps the capital gains taxes in check. Another cool trick is tax loss harvesting, where you offset your wins with some losses to balance the tax impact. While taxes on dividends can be a bit of a headache, a little planning and strategy can turn it into a manageable, if not advantageous, part of your investment journey. So don't let taxes scare you off from dividend investing. Just be smart about it. 4. Not considering aristocrats or kings. Have you ever heard of dividend aristocrats and kings? No? They're not characters from a medieval tale, but they're the royalty in the investing world. These stocks pay dividends and have been increasing them year after year, showing a level of consistency and reliability that investors adore. Dividend aristocrats are like the nobility of the S&P 500, offering dividends consistently for at least 25 years. Imagine a quarter of a century of not just giving back, but increasing the payout. It's a sign of stability and a pat on the back for any investor holding onto these stocks. Now, step it up a notch, and you meet the dividend kings. These are the creme de la creme, with a staggering 50 years of consecutive dividend growth. They're not confined to the S&P 500 realm, making their title even more impressive. So why should you care? Incorporating these dividend aristocrats or kings into your portfolio isn't just about earning extra cash. This strategy could fuel your portfolio's growth or provide a steady income stream. Think of it as a snowball effect, reinvesting dividends to buy more shares, leading to more enormous dividends, and so on. It's a cycle of increasing rewards. These stocks can be a cornerstone for those eyeing the horizon of retirement or seeking a steady income. Sure, they're not fixed income securities, but they offer a potential for growth and income that's hard to ignore. And in retirement planning, they could be the steady hand guiding your medium-term bucket, offering a blend of stability and growth. 5. Not considering DRIP. Now, let's say you've got a garden where every fruit the tree drops seeds a new plant, which in turn grows its own fruits. This is the essence of dividend reinvestment plans, or DRIPs, a tool that turns the dividends you earn into more shares of the stock, setting off a cycle of growth that can substantially increase your investments over time. With DRIPs, every dividend payment you get isn't just a pat on the back. It's an opportunity to buy more company shares without laying out extra cash from your pocket. It's like your investments are feeding themselves, growing bigger and stronger with each dividend cycle. Now, let's break it down with a simple story. Picture an investor. Let's call her Jane. Jane has 100 shares in a company that is generous with dividends, doling out $2 per share yearly. Instead of taking that $200 and spending it on a fancy dinner out, she enrolls in a DRIP. Fast forward 10 years, with the dividends growing at a steady 5% yearly, Jane doesn't just have her original 100 shares. She now owns 164, and her annual dividends have ballooned from $200 to $328. Without adding a dime, Jane's brilliant move to reinvest her dividends has significantly amplified her investment. But there's more to DRIPs than just compounding. There's also a masterclass in dollar cost averaging. This is where you buy more shares when prices are low and fewer when they're high, smoothing out the unpredictable swings of the market. So when the market dives, your dividends scoop up more shares on the cheap, setting you up for bigger gains when things bounce back. 6. Not considering the dividend growth versus yield. In the world of dividend investing, you're faced with a pivotal choice that echoes the classic dilemma of now versus later. Do you go for the allure of high immediate dividends, basking in the satisfaction of instant income? Or do you play the long game, choosing companies that promise dividends today and a future of growing payouts? It's tempting to lean towards high-yield dividends. They're like the financial equivalent of a fast food fix. Quick, satisfying, but potentially lacking in long-term nourishment. These companies grab your attention with their high payout rates. But there's a trade-off. Often, they're not reinvesting enough back into their own growth, which could mean they're not setting themselves or their investors up for a prosperous future. Now, let's shift our gaze to the slow and steady contenders, the dividend growers. These are the companies featured in the S&P 500 Dividend Aristocrats Index, renowned for their commitment to increasing dividends year after year for at least a quarter of a century. Their initial yields might not make your heart race, but there's more to them than meets the eye. These companies are playing the long game, balancing the act of rewarding investors today while reinvesting in their future growth. Choosing dividend growth over high yield is like investing in a sapling destined to grow into a towering tree, offering more shade each passing year. It's about building a portfolio that's not just profitable today, but continues to thrive and expand over time, delivering a blend of income and capital appreciation that's hard to beat in the long run. And that's a wrap. So, after uncovering these insights, how will you tweak your strategy to avoid these common mistakes and supercharge your dividend investments? Share your thoughts and strategies in the comments below. Also, make sure to leave a like, subscribe, and turn on the notification bell.